Hello and welcome. It's Tuesday morning, May 27, 2025, and I'm your host, Sunil Thakker. Sunny Talks Money. Hope you all had a good long weekend, yesterday being a trading holiday for Memorial Day. So, welcome to ST Money's 7 a.m. early morning news, where we provide you the latest, concise, and precise stock market wrap with accurate figures and numbers. Please mention your email in the comment section so that we can forward you the daily market wrap in your inbox at exactly 7 a.m. Eastern Time each weekday. On Friday, May 23rd, Wall Street ended a choppy week on a sour note as fears around escalating trade tensions, surging bond yields, and policy uncertainty sent investors scrambling. Major indices closed in the red, capping off a week marked by rising volatility, weak earnings in key sectors, and growing unease over the federal government's expanding deficit. Markets are increasingly caught between macroeconomic tailwinds like improving PMI data and headwinds including fiscal stress, tariff threats, and a bond market that refuses to calm down. So let's look at the market wrap. All major indexes end lower. S&P 500 fell 0.7% on the day and closed the week down 2.5%. Its worst weekly showing in nearly 2 months. The Dow Jones Industrial Average slid 0.6%, weighed down by industrials and energy, and the Nasdaq Composite dropped around 1%, pulled lower by tech giants under pressure from trade policy concerns. It was a risk-off session with defensive sectors outperforming while growth names and consumer cyclicals lagged. So, what were the market drivers? What's behind the drop? Number one, trade war 2.0. Trump tariff threats jolt global outlook. President Donald Trump hinted at sweeping new tariffs, 50% on EU imports and 25% on foreign manufactured smartphones. That directly targets major players like Apple, which fell more than 6%, dragging the broader tech sector with it. Markets fear a retaliation spiral from EU and China, reigniting fears of a global trade war just as supply chains have begun to normalize post COVID and post China de risking. Two, bond market blues. Yields break higher on weak auction and credit fears. Bond yields surged again. The 30-year Treasury yield briefly topped 5.03%, its highest since 2023. The 10-year yield also climbed, driven by poor demand at the $16 billion Treasury auction earlier this week and investor concern over the $3.8 trillion projected deficit tied to Trump's new fiscal bill. The bond market is flashing red about US creditworthiness, especially after Moody's downgraded the US sovereign credit outlook, citing fiscal indiscipline and political dysfunction. What are the sectors to watch? Tech and retail feel the heat. Technology. Apple led declines and semiconductors followed suit. The Philadelphia Semiconductor Index dropped over 1.5%. Traders fear margin compression as tariffs could raise input costs for devices and components. And in retail, Kohl's plunged nearly 8% after earnings missed expectations and foot traffic trade data showed soft consumer spending. The retail sector is struggling with inflation fatigue and weak guidance heading into summer. Three, energy. Oil prices fell on news that OPEC may increase output in July, dampening optimism about recent price stability. Brent crude slipped 0.7% while WTI dipped under $62 a barrel. Energy stocks followed suit. In economic data, they were mixed but slightly encouraging. S&P Global Flash US Composite PMI rose to 52.1 from 50.6 in April, signaling an expansion in private sector activity, particularly services. Existing home sales fell again, showing that high mortgage rates and low inventory continue to dampen housing activity. Jobless claims ticked higher, with continuing claims reaching their highest since 2021, an early sign the labor market may finally be softening. In currency and crypto, dollar fades and Bitcoin soars. The US dollar index weakened slightly after three straight days of gains as forex traders digested the implications of Moody's downgrade and the rising budget deficit. Meanwhile, Bitcoin soared over 3%, breaking about $111,000 for the first time. Ether followed. Traders cite growing distrust in a fiat system, and central banks combined with speculative flows. The Senate's progress on stablecoin regulation also gave crypto markets a bullish nudge. Global snapshot: Europe hit hard by US move. European markets fell harder than Wall Street, with the DAX down 1.6%. The euro weakened and the German bond yield spiked, reflecting fears that Europe will respond in kind to new US trade measures. UK borrowing came in higher than expected in April, adding fiscal pressure just as Bank of England is trying to stay hawkish. What about investor sentiment? They are jittery, not panicked as yet. Market breadth continues to narrow. Fewer and fewer stocks are driving returns, and high risk trades that worked in Q1 are losing momentum. The so called AI rally has lost steam, and value names are not stepping up to take the baton. As Andrew Sliman of Morgan Stanley put it, the market seems tired. What has led the rally is the high risk stocks that's running out of steam. My final word: the positioning of uncertainty. The US market is at a critical juncture. The narrative has shifted from soft landing optimism to questions about policy credibility, debt sustainability, and trade frictions. Stocks are trying to stay resilient, but headwinds are building. A nervous bond market, political motivated fiscal expansion, geopolitical tensions, weak breadth in market leadership. Investors will need to stay nimble, balanced, and tuned into policy signals as we head into the summer stretch. So stay tuned for more updates on the evolving market landscape. Thanks for watching and stay sharp. And if you got value from this, please do subscribe, like, and share this video as much as possible. I will see you again tomorrow morning. In the meantime, happy investing, stay inspired, and remember, it is all about money.